Hey everybody, welcome to Money's No Object. I'm your host, Dylan Howell. This is episode number 352 of our YouTube channel and podcast, and I could not be more excited to continue sharing with you guys personal finance topics that I think could be useful for you in your long-term financial journey. Today, we are going to be talking about retirement withdrawal strategies. And I know that from time to time, I talk about the need to take money out of your investment accounts. And there's no time that is, more vital to take money out of your investment accounts than retirement. And so we want to make sure that we get it right, and we want to make sure that we do the right things and that we plan accordingly. Now, just one of these strategies is not the perfect one. Just one of these strategies may not be the only one that you employ, but it's important for you to know what some of your options may be and what the pros and cons of those options are. So stick around for a discussion of all those and more in today's episode. Before we get started, though, if you could go down below, hit the big red subscribe button, like this video, leave me any feedback in the comments down below, and I'll be sure to respond to anything you leave down there. If you're listening on Apple or Spotify podcasts, be sure to subscribe and leave me a review on either one of those platforms. Follow me on social media at MNO with Dylan, and that's really good supplemental materials to all the things I'm putting out in these long-form episodes on YouTube and the podcast every single day. And then if you need somebody to help you to build a financial plan and keep you accountable to that plan over the long term, then I can do that. Just DM me on any of the major social media sites and tell me that you are interested in financial coaching sessions, and you and I can begin working together, pushing towards your long-term financial goals and ultimately pushing you on towards long-term financial freedom, which is what I hope for every single individual who's watching or listening to this show on a day-to-day basis. Now, when you retire, where's your money going to come from, right? Are you going to have Social Security? Maybe, maybe not. Are you going to have a pension? Maybe, maybe not, right? For a lot of people, most likely not with a pension, right? Are you going to have some other way that you are going to continue to make income? Are you going to continue working? Maybe, maybe not, right? But what a lot of people can agree on is that when they retire, they are going to employ at least some of the funds that they have invested for themselves over the long period of time. Now, for some people, that sum is a small sum, right? They withdraw just a little bit of what they've put away because they don't need that much of it. Maybe they've got other sources of income. Who knows, right? But then there's other people, and this is not uncommon, and it's not necessarily a bad thing. There are other people who rely heavily on the money that they've invested to, live in retirement. And again, this isn't a bad thing because some people didn't have pensions. Some people didn't have, or don't have Social Security, right? Some people see Social Security as just a drop in the bucket as to what they may need. Some people don't want to rely on the government for the amount of money that they want to be able to live financially free. And trust me, the amount that Social Security gives you is not enough to live that financial free life that you look forward to living in retirement, right? So what we want to make sure of is if we are trying to take money out of accounts when we are retired in some capacity, we want to make sure that we get it right. Because the last thing that we want is, one, to mess up anything associated with our taxes or whatever. But two, we don't want to draw down accounts to the point where we're going to hurt our future self. All right, we want to keep our future self set up well while still maintaining the withdrawals that we actually want from a specific account, right? And there are 5 specific withdrawal strategies that we're going to talk about today, right? There is the 4% rule. There are fixed dollar withdrawals. There are fixed percentage withdrawals. There are systematic withdrawals, and there are buckets, right? So we'll talk about what all of these look like, and we will begin with the 4% rule. But the right strategy of these 5 is going to depend on how much money you have saved, how concerned you are about running short of money in retirement, whether you're considering extreme early retirement, right? That's obviously going to impact how you choose to take money out, right? If you're part of the FIRE movement, the financial independence retire early, that will definitely change your strategy. And ultimately, how much income your investments produce will impact the strategy that you choose. Now, whatever strategy you select, you must withdraw enough money from tax-advantaged accounts such as SEP IRAs, simple IRAs, traditional IRAs, 401ks, whatever, right, to meet the IRS rules for required minimum distributions in retirement, right? That's a reason that we may be, taking some type of distribution. These just mandate that you withdraw a certain percentage of your investment account every single year after age 72. So you would have to pull from those accounts anyway. Now, if you don't, you're subject to a tax penalty. But what we're really focused on here is not the RMD side of things, not the have to, because that can be decided for you by that specific percentage, right? What I'm focused on here is the need, right? What money do you need to take off, and ultimately, which one of these strategies works best in providing for your financial needs. So, like I said, we'll begin with the 4% rule, which I have an episode out there on the 4% rule, so I'm not going to spend all day on it, but it is one of the strategies, and I want to cover it. So if you follow the 4% rule, you'll withdraw 4% of your investment account balance in your first year of retirement. Each year, you'll increase the amount to keep pace with inflation, the rising cost of goods and services. Now, this means that even though you're going to take 4% in year one, it may not be the exact same 4% in year two, or it might still be 4%, but you just keep growing your money at a pace faster than 4% every single year. And so you just take 4% of a higher number. And so that adjusts you for inflation. And that's something that we cannot forget to take into account when it comes to our retirement withdrawals is inflation, right? Because people think they're going to be retired for like 10 years. And that's just, one of the worst assumptions that we can make in personal finance. The likelihood is you're probably going to be retired for 20, 25 plus years, right? So having your money invested properly and ultimately taking care of the inflation boogeyman that's just around the corner that may rear its ugly head from time to time, like it is right now, is very, very important. Now, if you follow the 4% rule and begin retirement with a nest egg of $500,000, you would withdraw $20,000 during your first year of retirement. If there's 2% inflation, which is the Fed's target, right, you would withdraw $20,400 the following year, right? So they're just saying tack on an extra 2% on top of the 4% that you already took out, which is perfectly fine as well. Now, the major benefit of the 4% rule is that it's a simple approach and your buying power keeps pace with inflation. However, with rising interest rates and increased market volatility, there's a risk that you could run out of money using this approach, right? This rule also doesn't provide flexibility to adjust based on performance of your investments. Now, there's this chart that shows the income that would be available to you over a 20-year retirement if you were to retire with $500,000 in 2020 and follow the 4% rule, assuming a 2% inflation rate. And if you followed this withdrawal schedule and your investment account earned an average of 3% annual return, your balance at the end of 20 years would be approximately $243,518. Now, this is not necessarily what we want. I'll just say it. This is not what we want, right? We do not want the value of our nest egg to be declining, especially by more than half over a 20-year period. If anything, we want to continue to grow our money in retirement. We want to make just as much, if not more, than the amount that we are taking off every single month, every single year, whatever it is. So a 3% average annual return means that you're not investing your money in a proper way, or you're vastly underperforming the market, which is neither one is a good outcome. Okay, so we need to make sure that we properly invest our money. But if you're following the 4% rule, then you need to make more than 4%, and you need to make more than an inflation-adjusted 4%. That is very, very important there, okay? So that's the 4% rule. The 4% rule is very, very simple, right? It gives you this percentage that you take out, and you adjust for inflation every single year as well, okay? So that can be useful, right? But some people are going to need more than 4%. If you have a $500,000 nest egg, taking $20,000 a year off, it can be useful, but that may not be everything that you need, right? You may need more than that. Now, obviously, an easy adjustment for that, if you need more, would be to have a larger nest egg. But even with, let's say, $1 million nest egg, then you would still be only creating $40,000 a year, and that's not inflation adjusted, but still, right? That's not a ton of money, especially if you're used to living on, let's say, $100,000 a year, right? So the 4% rule, it has its drawbacks, right? But there are some other strategies that look similar that we can take out money in those ways that may be able to fix for those drawbacks. So there's not just the 4% rule. Obviously, that is something that is kind of arbitrary, follows a lot of old data, has been widely used. But the other withdrawal strategy, the second withdrawal strategy, is the fixed dollar withdrawals, okay, which, no surprise, involves taking the same amount of money out of your retirement account every year for a set period. Right? For example, you may decide to withdraw $20,000 annually for the first 5 years of retirement and then reassess. Right? And in doing so, you may, like I said earlier, it's very important to take inflation into account. So you may be, in that particular example, in this strategy, taking inflation into account and saying, okay, by 5 years from now, right, $20,000 may not be enough anymore for me to take off of this account, right? $20,000 may be running a little short because of inflation. So you give yourself these fixed intervals over which how much money you're going to take out, and you're going to know how much money you would have to make in your account in order to make up for the loss in your fixed dollar withdrawals. Now, the major benefit is that you have a predictable annual income and can determine the amount to withdraw based on your budget in your first year as a retiree. However, there are substantial downsides. If you don't increase your withdrawal amount, you lose buying power over time as a result of inflation, right? So even though you may plan for inflation in these withdrawals over some fixed period of time, every single year, if you're making the same amount of money, just like if you make the same salary year over year, you are actually making less money. Your buying power, your purchasing power is declining because you can buy less goods and services with that same amount of money because of inflation. Okay, and if you set your fixed dollar amount too high, you run the risk of running out of money in retirement, right? You can take out the same amount of money every single month or year or whatever, but if that amount is too high and you're not making enough money in your accounts to keep up with that withdrawal, then you could run out of money in retirement, which is a worst case scenario, right? So if you just look at the purchasing power of a $20,000 annual withdrawal over time, again, you assume 2% inflation. You look over a 20-year period, and $20,000 becomes worth a lot more, like $13,500 or so, right? It really slashes down. Even at a 2% inflation rate, it's inflation adjusted value. So you need to be careful about taking fixed dollar withdrawals, because ultimately, over time, that amount of money is not going to buy you the same amount of things anymore. Now, fixed dollar withdrawals, they can be useful, and the reason that they can be useful is, again, because they are predictable. And again, if you're taking these fixed dollar withdrawals, it doesn't mean that you have to stay taking fixed dollar withdrawals. You may adjust what your fixed dollar withdrawals look like, right? But what you may do is, in the early years, have some number, if you know you can live on that number, and take that money out and and plan for inflation that is going to occur, and know that over time you'll still have plenty to buy the things that you want to buy, but maybe you'll be able to enjoy those early years a little more with some more residual income, with some more purchasing power, and just know that your purchasing power would decline over time, and plan accordingly. Okay, so fixed dollar withdrawals, I think, is a decent idea. I don't think it's the best idea, though, when it comes to retirement withdrawals, simply because overestimating your withdrawals can decimate your retirement accounts and it can ultimately lead to decreases in purchasing power over time. But underestimating may force you into this place where there's a lot of uncertainty, and if you underestimate what those withdrawals need to be, you are losing purchasing power on less money than you actually need, which makes things pretty tight in the budget, right? So I don't think that's the best idea, but it is one particular strategy that you can use. Then another retirement withdrawal strategy that we have is the fixed percentage withdrawal. And I like the fixed percentage withdrawal, okay? This involves withdrawing a fixed percentage of your account balance every single year. So, for example, you take out 3.5% or 4% of your total invested funds every single year. With this approach, the amount you withdraw will vary as your investment account balance rises and falls. Okay, so let me just give you an example that could occur over the course of however many years you want to look at, right? So let's just say that you have your money invested in retirement, and maybe you've got a 60-40 portfolio, a 50-50 portfolio. Who knows? Who cares? Okay, but let's say you've got $2.5 million, which would be a nice little nest egg, right? That'd be a nice little nest egg to have saved up for you and your family. Okay, now let's say you make on that 2.5 million 10%, right? You make 10% in 1 year, so that would leave you $2,750,000. Okay, well, let's say you decided you were going to take off 5% of your investments every single year. Okay, so that means that you would take $137,500 off of that $2.75 million. Okay. And so now what we're left with after that particular withdrawal, right, would be $2.6125 million. Okay. Now let's say you had that amount, you started with that amount, but let's say the value of your accounts declined by, 18% the next year. Okay, which is a very bad year, but could definitely happen. Right? Let's say it declined by 18% that next year. Well, that would then leave you with $2.142 million, which is still no slouch, but now you have less money than you began with. Okay, but again, we are going to take 5% off. Okay, we're going to take 5% off of that new account value. And so now I would take $107,112.50 off of my account for that year. Right, so it's $30,000 less than I took the year before, but I'm taking off the same percentage, which is commensurate with the amount of money that I actually have. Now, something that's useful about this is that you'll never run out of money. Now, the problem may be that, you get less and less if your account balances go down, which, is problematic, can be problematic, but the fact that you are just taking a percentage will allow you to, if you have a decrease in value like we saw here, get your money back in some reasonable amount of time. Okay. Now this differs from the 4% rule. Now I don't want you to think, well, isn't this just a 4% rule, but with any percentage? Not necessarily. Okay. Because you might choose a different percentage of your account balance to withdraw, and because you keep the percentage the same every year instead of starting with 4% withdrawal and adjusting for inflation. Here we are not making an inflation adjustment, right? All we're doing is saying, let's take our money, let's see how much it grows, see what it becomes, and then we'll take off a certain percentage, right? And then we'll let it grow or decline in value, see what it becomes, take off that same percentage the next year. And what this does is this allows you to take off that exact same percent every single year, and especially if you have a certain investment percentage that you think you'll probably make, right? This return that you think you'll make over time, then you can just set your withdrawal rate below the return, and maybe even below the return on an inflation-adjusted basis, and then you can take that amount of money out every single month, right? Or every single year, whatever, however you want to look at it, okay? But this can be useful. I like this setup. I like this idea. I think when I get to retirement, this may be something that I do. And the major benefit of this approach is that this system naturally adjusts for market fluctuations. But unfortunately, if you choose too large a percentage, you risk being left with too little money. Okay, so again, you want to choose a percentage that is, believable, that is realistic. Okay, but at the same time, you can know based on what you're invested in what is realistic and what isn't. Now, your income also changes from year to year, so it can be difficult to make financial plans, but it's actually very useful if you are somebody who has more than you need. And you're just really trying to enjoy what you have, right? So these fixed percentage withdrawals are really useful for somebody who, maybe in that example I gave, maybe I only need, $90,000 a year, right, in retirement. But I know I'm going to get well more than that by taking that 5%, and I just use that other money to give or to enjoy or whatever I want to do, right? So it can be useful in that way. If you, have more than you need and you're just, wanting to have a little fun with some money, it can dictate, whatever the percentage, dollar amount ends up being. That can dictate how much extra stuff or fun you have with your money that year. But ultimately, the better the market does, the more money you are going to be able to make, the more money you are going to be able to pull off. The worse the market does, the less you will pull off. But nonetheless, like I said earlier, you'll never run out of money, though you may be taking out less and less if the market continues in a downward fashion, okay? Now, that is the third withdrawal strategy. What about the fourth? The fourth is systematic withdrawals. Now, systematic withdrawals, they leave your principal invested throughout the entirety of your retirement, right? You withdraw only the income your investments produce from interest or dividends, okay? So what this is saying is that you only pull off the money that you make every single year. Now, the major benefit of this approach is that you cannot run out of money. Okay, so that's extremely valuable. Unfortunately, your nest egg needs to be quite large to provide enough income for you to live on. Your income will also vary from year to year depending on market performance, which, like I said, is okay, but again, is nicer if you have more than you actually need. This again makes it difficult to create a financial plan. And if your investment gains don't keep pace with inflation, you could see your purchasing power fall. Okay, so this is just saying, hey, take what you make, right? Take what you make out of your accounts. Don't take any more. Don't take any less. Just take the income that your retirement accounts create, and that's it. Now, I think that mixing something like systematic withdrawals with the fixed percentage withdrawals is, useful in strategy, right? I think, again, the systematic withdrawals can be useful. They're very, very simple, right? And it's going to make sure that you don't ever run out of money and that, you can likely have what you need if you do some proper planning. But without proper planning, systematic withdrawals can be a very negative thing because, either you withdraw too much or you're left with too little in your nest egg or whatever, right? But it still can be a useful strategy for you to employ in retirement. Now, what about the fifth and final retirement withdrawal strategy here? The final strategy that we have is called buckets, okay? Now, when you implement a bucket strategy, you have three separate sources of retirement income, all right? You have a savings account that holds approximately 3 to 5 years worth of living expenses in cash. You have fixed income securities, including government and corporate bonds or CDs or whatever, right? And you have equity investments or your stocks, right? Now, with this approach, you draw from your savings account to cover your expenses, and you refill that bucket with money from the other two, okay? Now, this enables you to avoid selling assets at a loss. When you refill your savings account, you do so either by selling stocks if the market is up or by selling your fixed income securities if they've performed well. If both stocks and bonds are down, you continue to withdraw from your savings. Okay, so let's just back this up and talk about it for just a second. Okay, so what this is saying is you have this savings account that has 3 to 5 years of your living expenses in it. Okay, you have your equity investments, you have your fixed income investments. You take money out of your savings account, right, for that year or whatever, right, however, whatever time period it is. And then you say, okay, I'm going to refill that savings account with my investments that have done well. So you look around and you go, okay, have my fixed income securities made money? And if the answer is yes, then you'll take some of the money that they made and put it into that savings account. Have my equity investments made money? If the answer is yes, take some of the money that they've made, put it in that savings account up to the reimbursement amount. So up into the amount that you took out of that savings account in the first place, right? In order to reimburse yourself. So what this does is this always leaves you with some liquid cash. It always leaves you with money in savings accounts that you can continue to pull out, but it allows you to reimburse yourself from your investments without ever losing money, over the long term, unless your investments just continue to tank for some reason. Now, if you can't reimburse yourself because your fixed income securities are down or equity investments are down or both, right, then that's okay. You'll just keep pulling from that savings account until you can reimburse yourself. That's why there are 3 to 5 years worth of living expenses. So if the market is down, or if both markets are down for some period of time, then you will still be able to live. You'll still be able to take money out that you need. Now, the major benefit of this approach is that you have more control over when you sell investments, and you can potentially grow your investment balance over time. However, it can quickly become time-consuming, and you still need to use another method to determine how much you can afford to spend every single year. Okay, so we need to make sure in this scenario that we know how much we can afford. We know how much we can spend, because 3 to 5 years of living expenses, who determined what that value was, right? And who determined, what you could expect to make in your equity investments and fixed income securities in order to reimburse that amount every single year. We need to make sure that we know what those values are and be very clear. I think buckets is a good idea, right? It's good in theory, but I think it's, like I said, it's a lot of work. And a lot of focus on reimbursement, and maybe having a little too much in cash for my liking. Okay, so again, if you were to give me a choice, I would say fixed percentage withdrawals is something that I'll probably end up doing. Systematic withdrawals can be useful, but that's a bit more arbitrary than is fixed percentage. I think finding a percentage that is reasonable and that you can make a higher percentage in your investments than that percentage, and just keeping your money invested, keep pulling off that fixed percentage every single year. Make sure that even if the market were to go down, you could still pull out enough money to sustain yourself. And obviously, in all of these scenarios, flexibility is key. Right? We don't want to get so stuck on a strategy that we're like, even if we can't take out what we need to live, that we just continue in the strategy. No, if you can't take out what you need to live based on the strategy, then you may need to reevaluate your strategy. You may need to reevaluate what you're doing with your retirement accounts, and maybe pick another strategy here that would be more beneficial to you over a long period of time. So I would suggest that be the case. Do not allow yourself to fall into, forced poverty just because you're trying to stick to some strategy. No. Find the strategy that works for you and that will allow you to continue to grow forward over a long period of time. Because ultimately, yes, we do want to keep pulling money off of our accounts. We want to get the income that we need, but we also want to grow our principal. We don't want to be eating into our principal balance over time. And I think the fixed percentage withdrawals is a useful way in order to do this. I'm not opposed to the 4% rule. I just think 4% is a bit arbitrary, and I think adjusting for inflation in all cases is absolutely vital, because if we do not take into account decreases in purchasing power of fixed values of money, then we are going to be in trouble when it comes to 20 years later and you're pulling the exact same amount that you were 20 years ago and wondering why your lifestyle doesn't look the same. That's why. Okay. So hopefully this is useful, right? Hopefully this is help past just the 4% withdrawal strategy, and this can help you to understand how maybe you can withdraw funds, what some of your options are, and by no means are these the only options, but these are some of the very well-known ways that you can do this. And I think every other way that you may choose will be some derivation of one of these strategies, and this doesn't just have to be used for retirement. Right, this can be used for paying for your kids' college in some way, shape, or form. Right now, that would probably be a little more specific to the type of strategy that you employ, but nonetheless, you can choose it for that. You can, choose it for, supplemental income. If you're still working and you want to be creating extra income for yourself, you can choose how to do that as well, right? But retirement is the biggest place in which we need to come up with a withdrawal strategy, and these are just some of the major ones, and hopefully they're helpful to you and can help to inform the way that you choose to pull money out of your investment accounts as you move into this retirement phase at some point in your life. So thanks for watching this video. If you could go down below, hit the big red subscribe button, like this video, leave me any feedback in the comments down below, and I'll be sure to respond to anything you leave down there. If you're listening on Apple or Spotify podcast, be sure to subscribe and leave me a review on either one of those platforms. Follow me on social media at MNO with Dylan, and that's really good supplemental materials to all the things I'm putting out in these long form episodes on YouTube and the podcast every single day. And then if you need somebody to help you to build a financial plan and keep you accountable to that plan over the long term, then I can do that. Just DM me on any of the major social media sites and tell me that you are interested in financial coaching sessions. And you and I can begin working together, pushing towards your long-term financial goals and ultimately pushing you on towards long-term financial freedom, which is what I hope for every single individual who's watching or listening to the show on a day-to-day basis. So tune in tomorrow as I continue talking about personal finance topics that I think could be useful for you in your long-term financial journey. So thanks for tuning into this episode of Money's No Object. I'm your host, Dylan Howell. God bless.